Hi there, Jackie and Jeff here. We're just wanting to have a little quick discussion about rising interest rates. It's a hot topic right now. Obviously, everybody's dealing with it. Everybody's dealing with a higher mortgage repayment. And so the question becomes, what do you do? So you have your annual spending plan. Hopefully, you've gone through the modules in the course. You've created your annual spending plan, and all of a sudden, interest rates goes up. One of your loans rolls over, and now you have more money going to your mortgage. What do they do, Jeff?
Well, firstly, I mean, there's really good news about the interest rate increases. I know that sounds weird to say that there's really good news, but there is because this is kind of like actually just something to be expected, right? This is just part of the economic cycle. It's roughly a 10-year cycle, and we go from these troughs to these peaks. And at the moment, we're in the trough, so we're kind of at the bottom of the market. And this is when house values are down, and this is when interest rates are up. And really the good news is like this is something to plan for and expect because you know it's going to happen. It happens, roughly every 10 years, give or take. And the other good news is that it's temporary, right? So this is not going to be forever. High interest rates aren't forever, and they it's just part of the cycle. But
That's
look,
a,
if you
that's a good point, though, because it's kind of like when you have that mindset of, oh, this this happened. So many people they may not have owned a home in the before 10 years ago. You know what I mean? They may not know that
yeah,
this is just what happened.
that's right.
And that means that it will go back. It can seem a little bit scary if you've not been through it before.
Mm. That's right. House values will go back up again. Interest rates will come down again, and so I would just be planning to get through the next 1 or 2 years because I think you're going to have higher interest rates for say roughly another 1 or 2 years, and you kind of just got to plan for that, right? And get through that time period, and that might mean you need to revisit your annual spending plan. You might need to allocate a little bit more of your income towards paying your mortgage, and that might mean you've got a little bit less for the in the wants category, and you might have to temporarily reduce the amount of wants or fund that you guys are having to get through this time period. But it's much better to do that than to like lose your house, right? You don't want to even consider losing
Yeah.
your house.
And
Um,
as much as possible, not touching your savings, right? Like keeping seed capital in your savings
that's right.
protected as much as possible, obviously within
Mhm.
reason. But if you can just, have a few less lattes
Yeah,
or
and for
something,
some people it might mean that your seed capital reduces for a year or even 2 years, but still get in the habit of putting some money aside for your seed capital because it's a fantastic habit to get into and one that you can ramp up more when interest rates come down more, or maybe you get a pay rise that would help ease that burden as well. But just get in the habit of putting some of that money for your seed capital. But I would be suggesting you go back to your annual spending plan when you know that your repayments are going to go up, and you just basically look at what can we trim out of other expenses, in the wants, what can we trim in the needs, like can we get cheaper power, can we get cheaper utilities, in any regular expenses that you've got, can they be reduced? Another thing that we're doing with a lot of people whose loans are rolling over at the moment, at with these higher interest rates. We are using that as an opportunity to refinance some people because there's some pretty good cash contributions out there at the moment. Banks are actually doing at the moment, might not last forever, but banks are doing 1% cash contributions. So if you've got a $500,000 mortgage, bank's actually going to give you $5,000, right? That's a 1%. And you might spend $1,000 of that on legal fees to change banks, give or take, but it's going to still leave you with roughly $4,000 in your pocket, which is $4,000 that you didn't have before. So that can be one good incentive, but that combined with maybe setting up your mortgage according to the fast track mortgage plan, Futurebound's fast track mortgage plan, then that gives you a double incentive to consider changing banks at the time when your interest rates are rolling over and you're about to go from a lower rate to a higher rate.
Yeah. Are there any deals right now? Like, are there particular banks that have like a particularly lower interest rate, or are you pretty much kind of in that same range and just need to kind of get through this
Mm.
stuff?
Yeah, the big four banks are much of a muchness with their interest rates. There's not much difference between them really. They're all pretty competitive with each other, but a couple of the banks are doing those 1% cash contributions. So look, that's quite valuable. We've had some people refinance recently, and they're getting $5,000-6,000 in their bank account, which is that's a reasonable amount of money. That's quite a helpful amount of money to fall into your bank account. Now, that also means you've got to stay with a new bank for a minimum of about 3 years, sometimes a little bit more than that, but about 3 years, so that they don't ask for it to come back to you. That's, I think usually at least 3 years is a good time to be staying at a bank, if not longer. And then if you haven't got your bucket system set up, maybe you want to use the offset system or something like that, then this is also a good opportunity to put some of that into place and really get going with your fast track mortgage plan, which gives you a really good sense of control. And Jackie, like, control is a lot of or lack of control is a lot of where a lot of anxiety comes from. So
Yeah.
so you know.
Going through a time like this when you feel like you don't have a handle on your finances can be add more uncertainty and more just kind of fear. But when you're going through this, and hopefully everybody who's taken the course and has their annual spending plan, okay, I might have to readjust. But that doesn't mean I kind of have this thought of like, oh my gosh, I have no idea what our future might look like because I have no handle on our finances. So having that control gives us security. So that's what I always say is when you are looking at your annual spending plan and anything has to change, there's always two major ways to change it. It's either you decrease your expenses or you increase your income, right? So you're always looking generally to do those two things when you are looking at where am I going to find more money. So if it's trying to increase your seed capital, or if you're trying to, um, get more savings there, or actually you have to decrease some of your wants because your mortgage has gone up, your needs have gone up, all of those kinds of things. Or you can say, hey, I'm going to get side hustle. I'm going to do some extra hours at work. I'm going to get a raise, like you can increase your income as well to do those. So which is something I think some people forget about. For some people, maybe you haven't had a raise in a few years and it's time to say, I think I need to get to that higher income bracket, that kind of thing.
Mm,
But what not to do, don't freak out. Don't
that's right.
freak out. You will get through it with just following some financial principles and just applying everything that you're learning in the course. You will get through it, and you will be much better off um, than if you didn't have these things in place. Yeah, sounds good. All right, we'll see you guys again soon, and have a good one.
For more financial tips, advice, and education, subscribe to us on YouTube and don't forget to hit that notification bell.